Hello and welcome to this version of our webinar. I have been receiving a lot of questions regarding penalties and how to get relief for those penalties for tax returns, whether it's entities, individuals, tax exempt organizations, things like that. And so what I'm going to do today is I'm going to kind of go over a little bit of that stuff for you, and hopefully put your mind at ease as what really is going to happen with those penalties, and then also let you know whether you have a fighting chance. And so today we're going to talk a lot about the penalties, what the penalties are, and then also how to take care of those penalties. Hopefully you get someone like myself or someone here at Anderson involved, whether it's just consulting with you, letting you know exactly what to do, or even handling it for you. We can always get a power of attorney and we can handle that kind of stuff for you. It's sometimes beneficial to have someone, a professional, look at these things because in the long run, what you don't want to do is provide some information that will actually be damaging to your case. And so a lot of times what I do is I'm the middleman between you and the IRS, and I make sure that I filter out anything that you tell me that we don't necessarily need to tell the IRS and that can be beneficial for you. So let's get into the webinar and we'll kind of talk a little bit about this issue that we're having. We all know who this character is. It's the rabbit from Alice in Wonderland. Now, what was he late for? He was always late, right? Alice followed him into the Wonderland because he was late for something. No one really understands what he was late for or where he was going. I think we kind of all determined in the end that he had an important meeting with the Queen and that he didn't want to lose his head. And so part of his issue was that he was late and he needed to get there on time, constantly looking at his watch, constantly looking at things he needs to do. Now, in my life, there's certain things that I need to be on time for. There's some on-time priorities that I have. Birthdays are very important to my wife. And you'll find out that a lot of these things are important to my wife, which is why they are important to me. So they flow down easily. Birthdays, I need to remember my kids' birthdays, remember my wife's birthday especially. Anyone that's important to me and family-wise, I usually try to remember their birthdays. In fact, my dad, I'm one of 9 children in my family, and my dad had bonused his secretary quite well when he was working as an attorney because she would remind him of all of our birthdays throughout the year. And so she not only was on top of all his court cases, but she was on top of reminding him of the things that he needs to remember. Anniversaries, of course, never forget your anniversary. Always important to remember and to be on time for that type of thing. Anything my wife tells me is important. If it's important to her, it's important to me. I need to be there. I need to be there on time. And what's my final thing that I would say is very important to me, at least, to be on time is my taxes. I want to make sure I file my taxes on time, April 15th, my personal tax every year. If I don't have the information available to get it on time, I want to make sure that I at least have an estimate of what I owe, and then also that I file that extension, because if I file that extension, I now have moved my timing to that October 15th deadline. And so it's important that even though you may not be ready for April 15th, that you contact your tax professional and say, hey, I need an extension. I want to move my tax priorities out to October and so that I can get my affairs in order and then also provide that information to you. You don't want to be like the rabbit. You don't want to be constantly late, constantly in a frantic panic, and you don't want to be, hopefully, not losing your head sometime in the future. So who is penalized? Late filing only is for pass-through entities, tax-free entities, and foreign taxpayer type informational returns. Now, part of the reason that these only get late filing returns is because they either don't pay taxes, well, they don't pay taxes, and their flow-throughs to individual tax returns. So 1120S, S corporations, partnership returns, those all flow to my individual, and so if those aren't on time, I can't do my individual on time. and I'm going to be penalized for the amount due. I pay my tax on those entities on my individual return. So the payments aren't being made at the S corporation level or the partnership level. They're actually being made at my individual level. Now, the tax-free entities, they obviously are tax-free. They don't have tax penalties, so they only have filing requirements. And we'll see later throughout the process of this webinar that sometimes they have filing requirements only if they meet certain levels of asset value and things like that. And so not always do you even have a filing requirement. Foreign taxpayers, a lot of these documentation, these documents that are being filed with our personal tax return. And so we aren't actually going to incur a penalty unless we file our personal return late. We can sometimes talk our way out of it if we file our personal on time and then later provide the document. Late filing and late penalty or late payment penalties, the returns that would incur those are us individually and C corporations. Now, us individually and C corporations, we both have a filing and a payment requirement. Because we owe the IRS and we have to pay, then we can also have a payment penalty. And you'll see that they can compound, and then there's also limits. If you're getting both penalties, there are limits to the amount of percentage of amount due that they can actually penalize you. So how much is the penalty? If we dig into individuals and corporations, now these are the entities or individuals. These are people that are going to have the late filing and the late payment penalty if you haven't done either one of those. Or if you haven't done both, you may have both. Now, the late filing penalty is 5% of your unpaid tax for each month or even part of a month that the return is late. The maximum penalty you will pay for the late filing is 25% of your tax due, and that's a 25% penalty. Now, the minimum penalty for return filed after 60 days is if you don't file your return within that 60-day period, the minimum penalty you're going to be charged is $135 or your tax due, whichever is smaller. So, in other words, if I only owe $500, I don't file my return for 60 days, they're going to charge me $135, even though that isn't 5% of, or even 25% of the total liability. I'm still going to pay that $135. Now, if my tax due is $75, then they will charge me an additional $75 penalty for paying 6 days after, or for filing 60 days after the return is due. Now, my late payment penalty is a lot smaller. My late payment penalty is 0.5% of the unpaid taxes per month with a maximum 25% penalty as well. If you file an extension and you paid, so this would go back to the scenario where I had mentioned that even if you can't file your return on time, we might want to get an estimate of what we owe. The reason we want that estimate of what we owe is because we want to make sure that at least we're paying on time. Because if we pay on time and then we file that extension, we can file later, but at least we've paid on time and then we won't incur any penalties. Now, there is a special rule with the IRS that if you pay 90% of the amount due at the time of your extension, because they realize that you may not be 100% accurate at that point of what you owe. And so if you pay up to 90%, you may not face penalties when the return is filed because they're going to give you a break because you paid a majority of the tax and you've covered your end of the bargain for the most part. The other thing that I haven't, excuse me, that I haven't written on this webinar is that the maximum penalty that you're going to be charged per month. So let's say if I have late filing and late payment penalties, the maximum I'm going to be charged is 5% a month. So if I haven't filed my return and I'm still incurring that late payment or late filing penalty, I'm not going to get charged that late payment penalty at the same time because the max is going to be 5%, which is my late filing penalty. Now, you also might be considering or wondering, why is the late filing more than the late payment? It seems like the IRS would want their money, right? That's true. They do want their money, but how are they going to know that you owe money if you don't file a return? Now, there's plenty of people, and the more and more I speak at events and go out and talk to people throughout the nation, the more and more we do that, the more and more I'm starting to realize that there's a lot of people that haven't filed for over a 10-year period, 5-year period, 6-year period. Now, the IRS, unless you are receiving 1099s or other types of income that are flowing to you that are reportable to the IRS may never know that you made any money. And so they're going to penalize you heavily for not telling them your income levels and then telling them what your actual liability is. And the late payment is fine. It's a lower penalty, and they don't mind even taking care of some of that penalty if we do certain programs, set up certain payment plans, things like that. But they want you to file because they want to know what you owe before they can, go after you, get money that you might owe them, and then try to secure any either assets or bank accounts in order to get that money. Tax-free entities. If you file a 990, which is a tax-exempt organization, a charitable organization, you would be charged $20 per day up to $10,000, or 5% of your gross receipts, whichever is less. That's the penalty for filing late. If you have gross receipts of greater than $1 million, you will be charged $100 days up to a max, or $100 days, $100 per day up to a max of $50,000 per day, or $50,000 total. And so you can see that tax-exempt organizations, because they are highly regulated, they want you to file tax returns. They want you to show what you're doing in that tax-free exempt organization. They also want to make sure that you're performing activities that are not going to disqualify your tax exempt status. And so they want you to file returns, let them know what's going on, and they're going to charge you heavily if you don't. Now, it could really hurt you if you don't if you don't file a return, and let's say you don't actually have a huge amount of gross receipts. In the first couple years you forgot to file returns, it could really hurt you, because those gross receipts that you do have could be being used for charitable purposes. And so we want to make sure we file those returns on time. Your 5500s are typically your retirement plans. Now, the retirement plans can have huge penalties as well. You have to realize that if you don't file your retirement plan on time, you may face two different types of penalties. The IRS is going to penalize you for not filing that return if you have a filing requirement. The Department of Labor is going to also penalize you because they also are in charge of regulating that type of an asset, and the payment plans, or the funds that are then being contributed into your retirement plans. And since they have some sort of control, they also want to make sure that you're being compliant. If you're not being compliant, the IRS is going to charge you $25 a day up to a maximum of 15 grand. And then the Department of Labor, their penalties can be up to $1,100 a day with no limit. And so you're really more concerned about the Department of Labor in this instance than you are with the IRS. Now, if your assets are valued at less than $250,000 in your plan, let's say your profit sharing plan or your 401k, solo 401k, you don't have to file a 5500. And so it's important to talk to us here at Anderson, as well as your tax advisors, anyone that has tax related knowledge, and then be able to ask them if you have a filing requirement. We can always let you know if you have a filing requirement, and then if you do, we can help you prepare those returns. We do have people here at our office that are have expertise in filing those things, and they can help you get those done quickly. Now, foreign filers. The foreign filers, if you are a foreign individual and you have any type of ownership in an entity, or you have bank accounts that are foreign held, so let's say you're in Canada, you have a Canadian bank account, you have to report that stuff to the IRS. The reason the IRS wants to know is they want to know where the money has potential to go. Because if you had a tax liability here in the U.S. and I transfer my funds out to a bank account in Canada, they have little access to that money at that point. Also, um, as we all know, that people in the past have tried to have money running through different accounts in foreign lands so that they could hide income or um, commit fraud. And so the IRS wanted to crack down on that, and they've included reporting requirements for foreign accounts as well as foreign individuals that own parts of your company or maybe are related to the company. Now, the 5471, 5472, those are related to foreign entities and foreign individuals. They're for different types of filings. Now, you would have, if you do not report those on time, it's just a fee of $10,000. They're going to charge you. It's not based on a per day type thing. The day that they include that as a penalty, they're going to send you a notice saying you owe them 10 grand. So you need to file your foreign information on time. Same with your foreign bank accounts, which is a FinCEN Form 114. You will be charged $10,000 if you do not file that on time. Now, there's two different types of late filing. One is the non-willful type. You will be charged $10,000 or no penalty if reasonable cause and the amount of the transaction or the balance in the account at the time of the transaction was properly recorded. So if you recorded that information on your return, but you didn't fill out the actual 114 form, then potentially, and you had reasonable cause for that late filing, you could potentially talk your way out of the penalty. Now, if you were willfully not filing the return, now you're going to get charged $10,000 or 50% of the balance of the account at the time of the transaction. So at the time of the transaction, if it was $100,000 in your account, you can get charged $50,000 in penalties. So if you if you have not filed something on time, and let's say now you have knowledge of that and it's the next year, and then you continue to not file it because you don't want them to be on you for the year that you forgot the first year, then now you're willful. Your compliance, your non-compliance is willful, and now you're going to face greater penalties, either 10 grand or that 50% of the balance of your account. $10,000 for each report filed after due date or does not include complete and accurate information. So you can also get charged 10 grand if you're, let's say I do file the form, but the form was not complete and accurate. And so what I told the IRS about that form or about that account is not true. And so if you were to be audited and they were to dig deeper into that, they may charge you another $10,000 for that information. Now, how do we get rid of these penalties? Because sometimes we make mistakes, right? Sometimes down the road we find things out that we didn't necessarily know about. Now, ignorance is not a reasonable cause to present to the IRS. We as taxpayers are supposed to know the law. We are supposed to know our requirement to file taxes, and then also the different things that we are required to file with our taxes. Do we all know that? No. That's why we depend on professionals like myself to do that kind of thing for us. So what can we do when we do get that penalty because we made a mistake? Now, there are some things we can do, and then there are some things you'll see that sometimes you have no solution. You're just going to have to eat the cost. So first thing we can do is we can file our returns on time. That's the obvious solution. Get our returns on time, get the informational reports in on time, and make sure that we're always compliant with our taxes. If you do not know when your entity is supposed to be filed, call us. Call us and ask, and make sure, put it on your calendar. Do something to where you're going to remember or have a reminder of when that tax is due or that tax return. Because the last thing you want is to have penalties and then dealing with the IRS hanging over your shoulders, looking at everything you're doing because you owe them money. If you are not ready, don't remember to extend. remember that you do have the opportunity to extend your tax returns. You can move them out an additional 6 months, and that'll give you plenty of time to get that information together, to provide it to your tax preparer, and then have him start preparing your taxes. Now, when we say extend, that doesn't mean when you extend that I can just sit on my butt and wait till October to get the information in, because then that's a drop dead timeline. Once you reach October 15th, you can no longer extend. You can't extend twice. And so once you hit that October 15th deadline and we don't have your information, or if we get your information on the October 15th deadline, we may try to get your return done, but there are no promises. And unfortunately, it's more the taxpayer's fault than it is the preparer's fault, because we get busy around those times. We will typically try to get it done, but we're not going to promise anyone that we'll get them done on time, because we have deadlines to meet as well, and we have clients that were timely. Now, so when you extend, I would recommend that you still collect your information as quickly as possible within the next month or two and get it in before that 6 months is up. Now, us as human beings, our nature, or at least a lot of our natures, are to push things aside and do everything at the last minute. We're too busy to do other things. But I can tell you, those people that push them back are the ones that end up paying the penalties, even if they extend. Because here's a perfect example. Let's say I was not aware, or I forgot about a huge amount of income that I received. Why you would forget about that, I have no idea, but sometimes it happens. Let's say I forgot and there's a huge tax liability with that. I may be paying penalties for not filing, or let's say I extended and I don't get it filed on time. I'm going to be paying penalties for not paying. And so the additional thing to filing within a reasonable amount of time after my extension is that way it allows me to know how much I owe, and then I can limit the penalties I'm paying on the failure to pay penalty. Because even if I extend, that failure to pay penalty is still going to be accumulating if I don't pay up to 90% of my tax due on April 15th. The other way we can do it is we can have penalty abatement. Now I'm going to go over some ways that we can abate penalties, and then some of the ways that it could help you, some of the ways that unfortunately you have no argument. So sometimes there are times where we forget to file and we may not have the opportunity to argue anything with the IRS because it was our fault. So the final thing is there are certain IRS programs with certain types of returns that will allow you to become compliant, because they realize that maybe you weren't aware that there were filing requirements, but that they want you to be honest and to come forward, and so they're not going to hurt you as much by letting you come forward on your own, as opposed to them reaching out and telling you, by the way, you should pay us. Okay. So filing returns on time. When are your returns due? 1040s, which are your individual tax returns, are due April 15th or October 15th if they're extended. So if you extend your return, you have till October 15th. Once October 15th hits, that's the deadline. You can no longer extend. If you're late at that time, there's nothing we can do for you except maybe try and get your penalties abated. 1120s, they used to be 3 months and 15 days, but as of last year with the Highway Funding Act that Congress passed, they are now moved to a 4-month and 15-day deadline. So if your year end is December 31st for your C corporation on an 1120, you would file April 15th just like a personal. And it actually makes more sense that way for them to change it that way, just because it makes more sense for the flow-throughs to be earlier and the things that don't flow through to be later, because usually they're flowing into those items or those entities. The only return, if you have a June year end, you are still at the 3-month and 15-day filing requirement. So you would still file September 15th if you had a June year end. That's the only month that they're continuing to keep at the 3-month 15-day filing period. Now 1065s, those and 1120Ss. 1120Ss are S corporations, 1065 are partnership returns. Both of those are going to be due March 15th every year. That's the first original deadline. If you extend, they will be due September 15th. Once again, just like individuals, September 15th is the deadline, the cut time. If you do not file by September 15th, you will face a penalty. That penalty is actually going to be for our 1065s and 1120Ss. The penalty is $195 per month per shareholder or partner for up to 12 months. And so if you have a number of partners or shareholders in your S corporation or partnership, you can see that that amount can add up really quick. Now, I've had clients that we've ended up getting them abated because it was unreasonable for the IRS to charge them this amount of money, but they had a significant amount of partners, and their bill was somewhere up to $1 million in penalties, just because each individual partner, $195 a month for up to that 12-month period. And so we were able to get some of that abated. They still had to pay a little bit of a penalty because they didn't have the other abatements available to them. Now, the 114 FinCEN reports, those are due on June 30th every year. And so you would need to file those every June 30th. Make sure they're on time. That's a $10,000 penalty. Make sure you file those on time, and that's just the deadline. That's when they're due, the date. 5471s, 5472s, because they typically are in relation to like an entity or a tax filing of some other sort. They are actually due with the actual return that you file. And we'll see that if we file a return late without that 5472, if we file a return late with that 5471 and that 5472 with the return, then there's little we can do with our penalties. But if we file the return on time and we just forget to put in the forms, there are ways we can correct that in a quick timeline and be able to handle the penalty abatement for that. Now, the IRS has come out with what's called the first-time abatement. First-time abatement is their way of saying that we understand people make mistakes. The IRS, and this is a fairly recent enactment that they've had, because they found that most people were avoiding the IRS, and so they wanted people to be more compliant, and so they gave people a break with their first time. Now, if you don't have to file a return, there are times where you're not needing a return at all because your income levels are low, or you don't have activity in a partnership, things like that. Or if you have not had penalties in the past 3 years' returns, then you are eligible for that first-time abatement. You also would have had to file all currently required returns or extended them, and you would have had to have paid or arranged to pay any tax due. And this does not apply to tax-exempt filing penalties or foreign filing requirements. They have different things. First-time abatement is only for individuals, C corporations, S corporations, and partnerships. Now, the important thing to remember is that you do have to pay the tax. Otherwise, the penalties are still accumulating. If you don't pay the tax, the penalties are still running. They have no reason to abate them for first-time abatement because there's no set penalty yet, and so they don't know what they're going to be removing. Now, if you arrange to pay the tax, like setting up an installment plan, calling a tax attorney like myself to negotiate with them a way to pay back your tax, then that's when you can also get those penalties abated, and then we can work on just making sure you're paying the tax due. So the first-time abatement only available to partnerships, S corporations, C corporations, and individuals. None of those other $10,000 penalties are going to be handled under that first-time abatement program. Now, reasonable cause. Reasonable cause is always a way for us to remove penalties, and it doesn't matter what it is. It could be a foreign filing form. It could be a C corporation, S corporation, any type of return that we're receiving penalties on. If we have reasonable cause, then we can get those removed. Now, a lot of times, reasonable cause is hard to prove or hard to establish with the IRS because they're typically only going to accept circumstances that were beyond the taxpayer's control. If it wasn't beyond your control, you had control over your affairs, then a lot of times they're gonna keep the penalties there and they're gonna deny your reasonable cause statement. Now, what equates to reasonable cause? Here are some examples. Death, serious illness, or unavoidable absence. I have seen instances where a family member has passed away and they didn't remove the penalty. Now, you can always appeal the penalty denial. You can appeal that and then hopefully get it taken care of in the appeal process. But I have seen it to where someone died or passed away, a family member, and the IRS still rejected their claim, saying that they still could have filed their returns, even though I'm assuming that the person that denied it has never had a family member pass away. A lot of people don't have the capacity to do much, especially depending on the relationship that you have with that person. Serious illness, unavoidable absence, fire, casualty, natural disaster, or other disturbance. I have a particular case that I can cite for you right now that as long as we're talking about these casualties, natural disasters. Now, there was someone that brought a case to the IRS to have some penalties removed, and it was American Friends of Yeshivat or Yerushalayim Inc. I probably butchered that name. It sounds like it's probably a Jewish organization. But anyway, what they had was they had the argument that they had a flood and that the flood damaged all their information. They weren't able to compile the information in order to prepare their taxes on time, so they asked for abatement. They actually took it to the tax court, and the tax court, actually it was the state courts. They took it to the state courts. The court said that because your bookkeeper did very little to secure those documents, in other words, he could have gone down there and grabbed as much of the documents, wet or not wet, and picked them up and tried to dry them off, and then he didn't put any effort into it. He just said, oh, there's a flood, we're good to go. And they said because you didn't do anything other than assume there was a flood and that you were protected under that, that the penalties were not going to be removed. They had to pay the penalty, and their abatement was denied. There are times where we make mistakes. Like, for instance, we file a return maybe in a different time that we thought we were supposed to. Maybe we have advice, or we've relied on advice from our CPAs or from the IRS themselves. And so those are some reasonable cause aspects that we can use to get those penalties removed. Now, I put ignorance of the law in here because you can use that as an argument. We could try to get penalties removed using ignorance of law. However, I believe that the ignorance of law would have to be something that is so minute that most people would not be filing that type of return or would not be caught up in that same similar circumstance. So it has to be so out of the ordinary that the ignorance of the law would be applicable to us. So if we look into that, those are some of the things that we can have reasonable cause. I can give you some more examples. So we have the examples include death. To make reasonable cause determination, all factors have to be evaluated based on the facts and circumstances of each case. So they're going to take each case separately. So just because someone didn't get, the perfect example is I gave you the example of the death in the family. Now, if I were to present it a little bit differently, stating that it was a family member in which you had a close relationship with, and that you were finding it hard to even function, to go to work or do anything like that, then you might have more of a statement that's going to be more reasonable for the IRS in order to have them abate those penalties for you. So you can see that each different circumstance is going to be different. wrong advice might be taken differently. If the IRS gives you advice and they tell you what you should do, and you can run with that no matter what, and you should get your penalties abated no matter what if the IRS gives you advice. We do have a Revenue Procedure 84-35. Now these apply to partnerships. If you have a partnership return, you do not qualify for the first time abatement. There's nothing to, well, you still have to be concerned, but there is another way out that doesn't necessarily require the reasonable cause argument. In fact, through this revenue procedure, they have deemed this a reasonable cause for the partnership. So if you have a domestic partnership with 10 or fewer partners, and they are all natural persons, which are individuals, not entities, and then each partner's share of each partnership item is consistent, meaning if I get 50% of income and 50% of all deductions, I'm not getting 50% of income, 45% of deductions. I'm not allocating deduction or income in an inconsistent manner with my partnership share. And then all the partners, let's say every partner, as part of my partnership, it is me and my wife that are members of this partnership, and we file our personal tax return on time, and we fully report our share of the income, deductions, and credits from that partnership on time with our personal return, then it will be deemed a reasonable cause statement for us to be able to remove that penalty. Because the reason that we file a partnership return, a partnership is an extension of the individual members. Now, a partnership, what they're doing is filing the information as it happens within the partnership. But who pays taxes on that? The partners, right? And so if the partners are paying tax on that income and they are actually recording that income consistent with their partnership agreement and they're filing their personal returns on time, the IRS isn't going to penalize you for sending in your informational return, which is your 1065 partnership return, at a later date or by accident at a later time than when it was due. Part of why they want a partnership return on time is because they want to know what income is being charged to each partner. And so if you're paying the tax on that consistently anyway, there is no reason for them to penalize you. And I think they've taken that into consideration and have allowed taxpayers an opportunity to get out of those penalties. Now, administrative relief. This is obviously a picture of someone that has complete faith that the hand of God is going to catch him and he's not going to fall off that cliff. It's the same thing with the IRS. If we call the IRS or we talk to one of the tax preparer or the tax helpers that they have down at the office in the IRS office in the state that you live in, you can actually go into the IRS office and they can help you prepare your tax return. Now, if they give you improper oral advice as to when your taxes are due, when your return is due, anything like that, you can qualify for administrative relief, which is saying, the IRS told me this. I followed your advice. You should not penalize me for following your advice. I had faith that what you were telling me was correct. And so, in that case, we can get your penalties removed because we relied on the IRS, which is going to be considerably stronger than relying on our CPAs, who are all of us are imperfect, and so our CPAs, even though they may have a good grasp on certain things, may not have a great grasp on when your returns are due or something like that. And so you want to make sure that the information you are getting is correct. Now, you can use the argument even with a CPA. If my CPA tells me that I didn't have a filing requirement, that is a good argument for the reasonable cause argument. That's a good way for us to get that penalty removed because we rely on tax professionals. And the IRS, even though they don't like to place blame on CPAs for things like that, things like taxes, penalties, everything like that, they don't want to place blame somewhere else. But if you're relying on that tax professional to at least tell you when your taxes are due, when your return is due, then that's consistent with something that they should know and something they should be able to provide for you, and you can rely on that information. it's assumed that you would rely on that information. Penalty abatement for international information returns. So those are those 5471s, 5472s, 114s. As I mentioned, you typically cannot get the first time abatement. There are rare cases where they will approve the first time abatement. If you have, if the IRS has allowed the entity that was supposed to file that 5471 or 5472, so let's say I filed my corporation return late and I had one of those documents that needed to be filed in my return and it was filed with my return, and the IRS first time gave me the first time abatement on my corporate return, there is a possibility that they will give you the first time abatement for that $10,000 penalty that you're going to incur for that form being late. Now, that's not a guarantee, because that's not a responsibility or a promise that the IRS is even going to give you that. And so we need to make sure those forms are on time. If you are foreign, make sure your return's on time. So what we're typically going to have to do is provide that reasonable cause argument. And our reasonable cause argument is typically going to be written, so it has to be on written paper, has to be sent in to the IRS, and in there should also be a statement that under the perjury laws that you agree with the contents of this letter that is being sent in, and that you're risking, perjury by suggesting that it is true and accurate, which means that now you could face, prison time if you're lying or defrauding the government. Filing the late international information with an amended tax return. Now this is the thing that I was mentioning before, where IRS has given us programs that we can say oops and then change the whole situation. So if, let's say for instance, I filed my 11/20 tax return, it had a requirement to file a 5472, and that I didn't file that form, or I forgot to put it in there, or my CPA forgot to include it in the tax return. And then let's say a month later, I haven't received any correspondence from the IRS. They haven't told me that I owe $10,000 in penalties. And I have a reasonable cause. My CPA forgot to include it or told me that I didn't have to file it, and that we're not under civil examination or criminal investigation. So if we've committed fraud and we're under criminal investigation, this is no longer available to us, because that's part of probably that criminal investigation, is whether or not we have foreign accounts that we're hiding money in. But if you have not filed one or more required international returns, you have reasonable cause, and the IRS has not. That's the important step. The IRS has not told us that we owe 10 grand yet, so it's not under their radar. We can quickly amend that 11/20 tax return and get that penalty and almost treat it as if the penalty doesn't exist, because they haven't told us a penalty exists. They'll accept that amended return with the correct information filed in it, and then it's as if it didn't happen. So sometimes catching that information quickly is going to help us, because then all we have to do is pay maybe our CPA to amend the return, or our tax professionals. But if we don't catch it, then we're going to have a hard road ahead of us trying to get that $10,000 removed. Our tax-exempt entities are 990s and 5500s, which are the charitable organizations, retirement plans, things like that. What we're going to want to have is always a reasonable cause statement. That reasonable cause statement has to be in writing, just like with our foreign filers. We can't call in and provide a reasonable cause statement over the phone, which I can do in certain instances. But we have to have reasonable cause with that statement, again stating that under perjury laws that we are agreeing to the statements in the written statement, that they are true and accurate. We have to include what prevented the filing, that the organization wasn't neglectful or careless, and that we exercise ordinary business care and prudence, that we did everything we could to make sure that this happened, and it just so happened that it didn't happen. And so And then we also have to tell the IRS that the steps that we are going to take to prevent future occurrences, to make sure that we're telling them we made a mistake, we do have reasonable cause, and that we have established procedures that are going to make it so that this never happens again. The IRS may be favorable to us in that instance and then remove that penalty that they've charged us. With our 5500s, remember once again, you do not have to file with assets less than $250,000. So don't even worry about it if you're late and your assets are lower than that, because you never had to file. Now there is a revenue procedure 2015-32, which is only for non-ERISA plans. What that means is, for non-ERISA plans, means that it's a solo 401k, or you and a spouse, or you and partners on your retirement plan, which means that ERISA does not control that plan. In that case, there is an opportunity for you to quickly file those returns, and then on the return notify the IRS that, yes, I know I am late, that my return is, in fact, you write on the top, delinquent return filed under Revenue Procedure 2015-32, eligible for penalty relief. And basically they will cap your penalties at that point. They're not going to remove all your penalties, but they will say that that it'll be $500 per delinquent return, so you can have multiple returns inside one retirement plan that has related plans to it. Let's say you have 5 in one. Now the cap, they're going to say $1,500 per plan. So as long as you tell the IRS that we were delinquent under this revenue procedure, that we are eligible for penalty relief, they're not going to charge you the astronomical penalties. They're just going to say, okay, make yourself compliant. We'll charge you $500 to make yourself compliant, and then $1,500 per plan. So if my plan has 6 returns in it, they're going to cap it at $1,500, which essentially won't be $500 per plan or per return. And so you would have to attach that reasonable cause statement as well to the return that you are filing, with the statement or the sentence on top of your return saying that you are seeking the provisions of 2015-32 revenue procedure. Once you do that, you're good to go. And that's, once again, a way for the IRS to say, we prefer for you to be compliant. Now, we understand that a lot of people, once they start incurring all those penalties, that the compliance factor may be hard for them, because once you stop paying, people get scared. They think they're going to go to prison, or they think that the IRS is going to take their house, they're going to take their business, they're going to shut down everything. That's not always the case. So the IRS, instead of being a scary, huge organization that's out there to put doom and gloom on all our taxpayers, they've allowed you ways to get out of these penalties. And then as long as you're compliant, you can use these programs. Once again, I stress that it's a good idea, if you're not going to use a tax professional or a tax attorney to actually do the penalty abatement for you, at least call and get some advice. Have someone let you know what your best route or best option is to get those removed, and then maybe take that route yourself at that point if you're willing to do that. But always call and at least get the advice from us, and then we can walk you through the steps. Now, once again, I put my information up here. Here at Anderson, I'm the individual that you will more than likely talk to if you have any type of tax controversy, penalty abatement, anything like that. Usually it comes across my desk. If I don't handle it myself, I usually look at it and tell the individual how to handle it that way. So take down my information, give me a call, shoot me an email, do what you want when you have these types of issues, and then we can work our way through them. Just make sure that you give me a call or shoot me an email. I would rather help you by giving you a consultation, for instance, on what you should do, than you having stress and not being able to operate your business. The more successful you are, the more successful everyone is. And so We want to make sure that we can remove those from your shoulders, take the weight off, and help you to continue to operate. I thank you guys for listening. And just to finish my webinar, the answer is yes, your penalties can be abated, penalties can be removed. There are processes. You had to know how to use the IRS and the information that they provide you. And with that, I say thanks a lot, and we'll talk to you guys next time. Thanks.